Okay, let me now introduce on the show Meeta Shetty, Fund Manager for Digital India and the Pharma Fund with Tata Mutual Fund. Meeta, thanks so much for joining us today on ET Now. I think the sectors that you manage are quite the cynosure of all eyes. They're the flavor of the season. The digital aspect, for various reasons, the fact that, of course, now we rather be focusing on apps developed by India. And then you have all of these, the paraphernalia of digital applications that one will be needing when working from home. And then, of course, pharma. Pharma funds have been the best performers for the year 2020 amidst this entire coronavirus pandemic. So let's break this down. Let's first talk about pharma. Some of your largest holdings are the big names like Dr. Reddy's, Divi's Labs, Sun Pharma, so on and so forth. I want to talk to you first about this entire Atmanirbharta move that we've been seeing. API and the raw material basically for pharmaceuticals is largely being bought from China. China is one of the biggest suppliers of API to India. Do you think that our own Indian companies have the capacity as well as the capability to be able to cater to the entire Indian API demand and replace imports completely?
Yeah, hi. So see, if you look at the API export, around 3.5 billion worth of exports is what we do on a yearly basis, and about 70% of that is coming from China alone. Yes, we have a lot of dependency on exports as well as our requirement is concerned. But if you look at in the recent initiatives taken by the government and a lot of incentives which are getting provided, government has in fact also shortlisted about 53 API KSMs specifically to encourage manufacturing, and incentives between 5 to 20% of revenue is what is likely to be provided. So I think all these things will eventually lead to a lower dependency on exports, particularly on any one country maybe. But I mean, it's a long way till we completely become independent, is what we believe. But a lot of initiatives have been taken, and I think they're in the right direction, which should help us ease our dependency on the exports.
Yeah, in fact, earlier today we as well. Do you think that could be a bit of a hurdle for Indian pharmaceutical companies? And how would you position yourselves among companies that have high US exposure, high Indian exposure, so on and so forth?
Sure. So if you look at the broad thought around shifting manufacturing back to the US land, I think that some bit of that we are seeing, some bit of initiatives taken by the government. But if you look at Indian from an Indian context, okay, we are fairly large as far as the formulations is concerned. In terms of the value, we are closer to about 15 to 20%. But then if you see the volume contribution, we are over about 45 to 50% or so. So clearly, we have a very, very strong presence as far as the formulation market is concerned. As far as the initiatives by government, they are very, very small at this point of time, and I think they also are clear on going very specific towards very specific drugs or very specific categories. But the amount of cost benefit we get to the overall global market, I think that will always remain very, very important when countries are taking manufacturing considerations on their own land. So I think we will always be relevant as far as the cost advantage is concerned, and which should remain in our favor for a much longer time. Coming to the question on how I'm looking at overall sector, be it domestic or US. So I'll break that into three parts. So if I look at the domestic segment, okay, domestic formulation, which is the medicines that we consume on a daily basis as Indians, that market has been a very resilient, strong market. If you look at the growth rates, they've been in near double digits for a large amount of time, bearing 1 or 2 years when there were specific events. But it has been a very strong market. We also have to remember that that's a branded market, so it's like a quasi FMCG market, which gives a very strong brand pull, and that makes it more resilient. particularly if I have to look at this fiscal, because of the pandemic, one clear thing which is coming out is that because the MRs are not able to meet the doctors and visits are not happening, the push factor which was driving the growth for small to mid companies, that is seeing some bit of a slowdown, and which is actually on the other hand helping the larger companies, the larger brands, because of the brand recall, they're growing faster. Even if I look at the data for the last 2-3 months, the chemist level data, which comes on a monthly basis, it's clearly showing that trend that after a very long time we are seeing the larger pharma companies growing in excess of what the overall say a 25 to a rank 150 companies would be growing. So the top 20, 25 companies are growing faster this time around. So I think that trend will continue for this year at least, and we'll see larger companies inching their market share higher because of the strong brand recall. Coming to the US side, yes, there has been a lot of talk and optimism around it, particularly in the last couple of months. But clearly, one trend is what I think is coming out clearly is that the US revenues for most of the larger companies, especially, were seeing a degrowth over the past couple of years after we saw the golden period, which was from 2010 to 2015. So the cut cycle, at least from what 2015 to 19 was, that is clearly now kind of showing some signs of stability, and I think that is what is at least now coming up. Also on the pricing front, so the US generic market is a deflationary market and it degrows every year. But the extent of degrowth had actually expanded to a very high number, high double-digit number in the last couple of years, which is now kind of coming to a very reasonable level of mid-single digit or so. That's what we keep hearing from the companies. And I think that's also a positive sign as far as the overall US generic side is concerned. The third part to your question would be the on the overall financials. If I have to look at the pharma companies, a 2 year back or so, or even a year back, most of the companies, if you have seen their balance sheet, if you have seen their operating cost levels, they were pretty bloated. The balance sheets were heavy with debt, and even on the expense side, we weren't seeing much. But at least now, companies have started focusing on rationalizing their spends. A lot of cost optimizations are getting done. On the balance sheet side also, most companies are now focusing on making it more leaner and going debt free. Some companies have in fact started to see that. Some will probably see that in a year or so. So I think on that front as well, we are seeing a tremendous amount of improvement.
Meeta, Digital India. Yesterday, we did have the big news that the government has banned 59 Chinese apps. Now, of course, this is going to give a big push to the Indian digital landscape. There are so many Indian digital apps out there. But for whatever reason, it was these Chinese apps that it did tend to be a bit more popular. The absence of these competitors with their, mind you, deep pockets, do you think it's setting up a good playground now for Indian digital companies to sort of push themselves out there? What's the potential you see among the listed space? We do know for a fact that the big four as well have been really focusing, or rather the big two, Infi and TCS at least, have been going all gung-ho on digital, especially these two companies. So what's your view on what this could do to the Indian digital landscape?
More of the startup kind of companies will fall into that category, and not necessarily the listed ones, especially the large ones. The large ones are more, when they talk digital, they are more talking about digitizing the operations and the customer experiences. So be it a bank and application of those bank apps or any other enterprise for that matter. So I think to your question on the newer apps which have been the talk of the town, I think the small startups definitely gives them a lot of opportunity. Coming to your question on the large names and their digital aspect, I think that yes, if you look at their digital portion on the revenue, it's closer to about 30 to 40% now, and it's been growing in excess of 20-25% year over year. So clearly, there is a lot of digital push which is happening from both the enterprise as well as the service providers level. But one has to also keep in mind that there is a lot of legacy also, which is currently sitting into the books of these larger names, which is where there have been challenges even pre-COVID. And post-COVID, we will have to see how each segment would react, be it retail or energy or aviation, or for that matter, even the banking side, because of the delinquencies which may come, due to the pandemic. So on the digital side, yes, things really look pretty good, and I think that should continue to do well.
All right, great. Thanks so much, Meeta, for joining us today on ET Now, and giving us a sense of what things could look like, as India seeks to be more Atmanirbhar.